Becoming rich in 10 years would be easy for you if you follow the 8 tips discussed in this video. So watch this video till the end. Now let's start. Number 1. Establish a budget and adhere to it strictly. Establishing a practical budget and adhering to it is a fundamental and crucial practice for accumulating wealth. Creating a budget allows you to monitor your income and expenditures, pinpoint opportunities for savings, and strategically allocate resources towards achieving your financial objectives. Successful wealth builders understand the importance of living within their means, ensuring that their expenditures do not exceed their income. This is referred to as maintaining a favorable lifetime wealth ratio, which assesses the wealth you have built in relation to your total lifetime earnings. To establish a budget, it is essential to begin by determining your net income, which represents your earnings after deductions and taxation have been accounted for. Next, compile a comprehensive list of your fixed and variable expenses, including items like rent, utilities, food, transportation, and entertainment, among others. To determine your monthly surplus or deficit, simply deduct your total expenses from your net income. Number 2. Steer clear of lifestyle inflation. Lifestyle creep, often referred to as lifestyle inflation, represents the inclination to elevate your expenditures in tandem with an increase in your income. Although it is understandable to desire the rewards of your labor, an increase in lifestyle expenses can hinder your wealth accumulation and obstruct your path to achieving your financial objectives. For instance, receiving a raise might lead you to consider upgrading to a larger home, purchasing a more luxurious vehicle, or investing in higher-end apparel. However, these purchases will not only elevate your expenses, but also what you want and desires. It's important to consider that you might soon require additional funds to sustain your new lifestyle, which could lead to a situation where you are living paycheck to paycheck. To prevent lifestyle inflation, it is essential to remain aware of your expenditure patterns and to exercise restraint against impulsive purchases. Allocate bonuses, unexpected windfalls, and any additional funds towards savings or investments rather than hastily spending them, in order to avoid the pitfalls of lifestyle inflation. Rather than allocating your surplus funds towards items that lack meaningful impact, consider directing them into savings or investments that have the potential to enhance your financial growth in the long run. Subscribe to our channel and also press the like button to know more tips to get rich quickly. Number 3. Identify opportunities for tax savings. Taxes represent a significant expense that can diminish your income and overall wealth accumulation. There are strategies available to help you minimize your tax burden and enhance your savings for the future. Utilizing tax-advantaged accounts like 401(k), IRAs, HSAs, and 529 plans is an effective strategy for minimizing your tax burden. These accounts provide an opportunity to save and invest funds for targeted goals, including retirement, healthcare, or education, while also offering tax advantages like deductions, deferrals, or exemptions. Number 4. Compensate yourself as a business would. One of the most effective strategies for accumulating wealth is to compensate yourself as if you were running a business. This approach involves managing your personal finances with the same diligence as a business, ensuring that you set aside a portion of your income for yourself before addressing any other expenses. This practice is often referred to as paying yourself first, or PYF. It is essential to focus on saving and investing for your future first, and then manage your expenses with the remaining funds. This approach will help you avoid the risk of allocating all your funds towards bills, debts, and various expenses, ensuring that you retain some financial stability and assets for the future. To compensate yourself as a business would, It is essential to first establish the amount you wish to receive and the reasons behind that decision. For instance, consider allocating 10% of your income towards your retirement savings, 5% for building an emergency fund, and another 5% for achieving your other financial objectives. It's important to tailor these percentages to align with your income, expenses, and financial objectives. Number 5. Leverage debt strategically. Debt is frequently perceived as a detrimental factor that can undermine your financial stability and hinder your ability to accumulate wealth. Nonetheless, debt can serve as a strategic instrument that enables you to optimize your finances and reach your financial objectives. It is essential to recognize the distinction between beneficial debt and detrimental debt, and to manage debt with wisdom and responsibility. Favorable debt is characterized by its potential to yield a positive return on investment, contributing to an increase in your income, wealth, or net worth over time. For instance, acquiring a student loan to support your education can be viewed as a beneficial investment, provided that the degree you earn will enable you to secure a higher paying position and further your professional development. In a similar vein, obtaining a mortgage to purchase a home can be viewed as a beneficial financial decision, particularly if the property's value increases over time and offers you a stable living environment. Number 6. Deplete your cash reserves and allocate funds for investment. One prevalent error individuals often commit in their wealth-building journey is allowing their funds to remain stagnant in bank accounts, yielding minimal or no interest. Maintaining a certain level of liquidity is essential for unforeseen circumstances and routine costs. However, excessive cash reserves can hinder your potential for financial advancement. To attain genuine wealth, it is essential that your finances are consistently engaged in productive investments. Assets that yield income, increase in value, or achieve both outcomes over time are classified as investments. Examples of potential investment options include stocks, bonds, mutual funds, exchange-traded funds, ETFs, and real estate, among others. Investing your money allows you to harness the benefits of compounding, where you earn interest on your interest over time. Utilizing compounding can significantly enhance the growth of your investments over time, allowing you to reach your financial objectives more efficiently. Number 7. Explore various sources of income. Another important practice for accumulating wealth is to identify multiple income streams, rather than depending on just one source of income. Diversifying your income sources can enhance your cash flow, lessen reliance on your main income, and provide a safeguard against financial surprises and uncertainties. To discover a variety of income sources, consider expanding your investment portfolio by including alternative assets and passive income opportunities, such as rental properties, peer-to-peer lending, crowdfunding, and royalties. These assets have the potential to generate consistent income with minimal effort or engagement on your part. One effective approach to establishing diverse income streams is to leverage your skills, knowledge, or hobbies. This can involve creating active income opportunities by selling your products or services, engaging in freelancing, offering consulting, teaching, or writing, among other options. These income streams can help you utilize your skills and interests, providing opportunities to generate additional income, whether part-time or as a full-time endeavor. Number 8. Establish achievable financial objectives. Building wealth is a systematic and purposeful endeavor, not a chance occurrence. To accumulate wealth successfully, it's essential to establish a clear vision of your goals and outline a strategic plan to reach them. Establishing achievable financial objectives is one of the most effective methods to bring your vision to life. Setting financial goals involves defining specific, measurable, attainable, relevant, and time-bound objectives that you aim to achieve with your financial resources. Now, watch the video appearing on the left side to know the signs that show your friend is secretly rich. Also, subscribe to our channel to help us hit our first 10,000 subscribers goal.